Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Virgin Galactic.
If you find our talks useful, please consider subscribe, like, and comment underneath. And I also want to mention right up front, check out the VIP Algos link below in the description.
Yeah, that VIP Algos tool is it's honestly incredibly helpful for mapping out the kind of market volatility we're going to talk about today.
Exactly. So let's jump right into this. Imagine you are holding $186 million in deposits for this ultra luxury experience, right?
Yeah. Sounds like a great problem to have.
Right. But there's a catch. You only have enough cash left in the bank to keep the lights on for maybe 8 more months.
Oh, wow. Yeah, that changes things.
That is the exact ticking time bomb Virgin Galactic is sitting on right now in 2026.
It's honestly the ultimate high-stakes corporate tightrope walk. You're looking at a company that is either about to unlock this massive, highly lucrative industry, or, and this is a real possibility, they completely run out of runway just, inches from the finish line.
Yeah, and that's our goal for today. We want to help you, the listener, look past all this incredibly bearish market noise. We need to understand this underlying do-or-die phase they are navigating right at this very moment.
Because it really is a transition phase. They're moving from what has basically been a pre-commercial research and development project into an actual functional spaceline.
Which is a huge leap.
Massive. And setting the scene here, the current environment for the stock is just incredibly grim.
Yeah, heavily oversold.
Extremely. Virgin Galactic shares are sitting around $3.03, down over 14% for the year. The broader market is essentially treating the company like it's already a lost cause.
But to understand why the market is punishing them so hard, and more importantly, why that $3 price tag might actually be like a massive mispricing, we have to look at the tension in their financials.
The gap between what they are spending and the demand they are hoarding.
Exactly. And looking at the ledger, the core reason for the market skepticism is just glaringly obvious. The cash burn is staggering.
It really is. The numbers in the first quarter of 2026 paint a very stark picture. The company generated only about $200,000 in total revenue.
Wait, $200,000 for the whole quarter?
Yep, total revenue.
And the most surprising part of that data is that this revenue didn't even come from flying people to space. It came mostly from what they categorize as future astronaut community fees.
Yeah, which is wild to think about.
Essentially, these are just membership dues people are paying while they wait for the actual flights to begin, like a country club fee.
Right, exactly. So you've got $200,000 in membership dues set against a first quarter net loss of roughly $65 million. And the free cash flow metrics are even more severe. They burned through $93.3 million in the first quarter. And projections for the second quarter, they anticipate another $87 to $92 million just going out the door.
So add all that up, right, and compare it to their reserves. They only have about $251 million in cash and marketable securities left in the bank.
Which is not a lot when you're burning $90 million every 3 months.
Not at all. If you just do the basic math, burning roughly $90 million a quarter with $250 million left, that gives them roughly 2.5 quarters of survival runway.
Yeah.
I mean, that is terrifying for any investor.
Oh, absolutely. It is entirely rational for the market to look at a 2.5 quarter runway and just panic. But that panic kind of ignores the other side of the ledger.
Oh, wait lists.
Right. They are sitting on $186 million in fully backed reservations. This is from 650 future astronauts.
And the ticket prices aren't cheap.
No, ticket prices are currently sitting at $750,000 a seat. So the operational leverage waiting to be unlocked there is just massive.
It makes me think of a company building a colossal, ultra-luxury hotel right in the middle of the desert.
Oh, that's a good way to look at it.
Right. Like the hotel is fully booked for years in advance. The wait list is huge. Those future guests have already put down millions in non-refundable deposits. But the hotel is still under construction.
So they can't actually let anyone in yet.
Exactly. Every single day, the doors remain closed. The company is just bleeding capital to pay contractors, run the air conditioning, maintain the grounds. But the moment those doors open and the first guest checks in, the revenue starts pouring in. And it completely dwarfs those daily operating costs.
I like that analogy.
Yeah.
And taking that hotel concept a step further, the reason their profit margins are so deeply negative right now isn't because the day-to-day operations of flying a spaceship are inherently that unprofitable.
Right. It's not the flying itself.
No, it's because they're currently paying the contractors to build the hotel, to use your metaphor. The vast majority of that $90 million quarterly cash burn is tied up in research, development, and manufacturing for their new fleet.
The Delta-class spacecraft.
Exactly, the Delta class.
And it seems like operating expenses are finally beginning to decline, right? I assume that means the primary design work for the Delta class is finishing up.
Yes. The heavy lifting of the engineering phase is wrapping up now. And the moment they transition from building the ships to simply operating the ships, that massive R&D weight comes right off the balance sheet.
Which is huge. And the underlying engineering shift here seems crucial too, because the previous ship, the VSS Unity, was essentially a handcrafted prototype.
Yeah, it was brilliant, but it wasn't scalable.
Right, because after a flight, engineers had to essentially tear it down, inspect every single composite structure for microstresses, and rebuild it. It took weeks or sometimes months just to prep for the next launch. You cannot run a profitable spaceline with that kind of maintenance bottleneck.
You really can't. The VSS Unity proved the physics worked. They know how to get to space. But the Delta class is an optimization engineered specifically to fix those exact maintenance bottlenecks.
Turnaround time.
Exactly. Turnaround time. In the aerospace industry, turnaround time is the sole driver of operational profitability. The goal with Delta is to land, refuel, run system checks, and fly again within a matter of days.
Wow. Days.
Yeah. If they can achieve that cadence at $750,000 a seat, the margins flip completely.
Okay, so that structural shift makes total sense long term, but we still have to reconcile that with the ticking clock. They only have enough cash to last until early next year.
The 2.5 quarters.
Right. Which brings us to the drastic survival maneuvers management is taking to just, avoid hitting zero.
They know exactly how short their runway is, which is why on June 22nd, the company executed a major debt exchange.
And the details on this swap are really aggressive. They took $52.5 million of their 2027 convertible notes and swapped them for equity and warrants.
Yeah.
This move effectively reduced their outstanding principal by 75%. It dropped their debt burden from $70.4 million down to just $17.9 million.
It's a massive restructuring of their obligations. It basically clears away near-term default risk.
But the market reaction was brutal. The stock dropped 5.17% almost immediately on the news. And this is where I have to push back a bit on behalf of anyone holding shares.
Sure, yeah.
They managed to avoid a near-term default, sure, but they did it by heavily diluting their current shareholders by issuing all this new stock. So is this a real lifeline for the company, or are they just throwing their current investors under the bus to delay the inevitable by a few months?
Well, the initial sell-off was a very natural reflex from retail investors who only see the word dilution. It scares people.
Yeah, nobody likes being diluted.
Right. But the fascinating part of this specific transaction is the institutional behavior behind it. Think about who holds those convertible notes. This wasn't a group of retail investors forgiving a loan. An eligible institutional investor willingly agreed to this swap.
Wait, so an institution holding BIT, which guarantees them a payout or at least a high-priority claim on assets if the company goes bankrupt, voluntarily traded that safety net for stock.
Yes.
That feels entirely counterintuitive if they actually think the company is dying.
Exactly. It reveals everything about how smart money views the long-term play here. By giving up the relative safety of debt, they are signaling that they want the equity exposure. They took common shares plus pre-funded warrants.
Let's clarify that jargon for a second for everyone. When we talk about warrants in this context, we mean the institution was given the right to buy even more stock later at a predetermined price, correct?
Correct. It acts as a massive bet that the stock will eventually skyrocket past that strike price. This signals that institutional capital is willing to take on long-term equity risk right now because they are looking past that current 2.5 quarter cash runway.
They see the other side.
Right. They are betting on the ultimate commercial success of the Delta fleet. Think about it. If they thought the company was going into liquidation in 8 months, they would have held on to the debt to protect their capital.
Because debt holders get paid before equity holders in a bankruptcy.
Precisely.
Yeah.
By absorbing the short-term pain of dilution, they are positioning themselves for the upside once commercial flights actually begin.
So it's essentially a massive vote of confidence hidden inside a move that looks terrible on a daily stock chart.
Yes.
But if institutions are quietly positioning themselves like this because they see the upside, why is the public narrative so overwhelmingly toxic? I mean, the sentiment out there is brutal. I'm looking at headlines, and short sellers are calling these companies nothing more than sci-fi wishes. Yeah. And other articles are declaring a June gloom for space stocks.
Well, Sci-Fi Wishes taps perfectly into the fear that space tourism isn't a real business, just, a very expensive hobby for billionaires. But the media narrative is actually being driven by a massive macroeconomic factor that has absolutely nothing to do with Virgin Galactic's actual ships or their business model.
You're talking about the recent SpaceX IPO.
Exactly. That single event reshaped the entire sector's liquidity.
It seems like this IPO just sucked all the capital and oxygen out of the room, causing a severe capital rotation out of smaller space peers. Let's dig into the mechanics of that. I assume this happens because there is like a finite pool of capital allocated to the space sector in most institutional portfolios.
You hit the nail on the head.
Mhm.
Portfolio managers operate within strict allocation limits. When a massive, proven, highly anticipated player like SpaceX finally goes public, those managers have to rebalance to include it.
They can't just ignore it.
Right. To free up the millions of dollars needed to buy into the SpaceX hype, they have to sell off their higher-risk, small-cap space stocks. Virgin Galactic basically became a primary source of liquidity for funds needing to buy SpaceX.
It's like being a fantastic, innovative indie rock band.
Oh, I like where this is going.
Right. You've spent years in the studio, perfected your sound, and you finally release your highly anticipated debut album on the exact same day Taylor Swift drops a surprise double album.
You're done.
You are going to get completely buried. It doesn't mean your music is bad. It just means the entire market is entirely distracted by the behemoth in the room.
That is a perfect analogy, and that dynamic creates what analysts call a technical divergence.
Meaning the stock price is completely ignoring the actual reality of the company's progress.
Yes. Right now, you have a macro-driven stock sell-off caused by the SpaceX IPO and these short seller reports driving Virgin Galactic's price down to $3. But that sell-off is happening concurrently with Virgin Galactic's fundamental timeline drastically improving.
Because their debt is cleared up.
Right. The debt is cleared up, the Delta research and development phase is finishing, and they are closer to commercial flight than ever before. The price is reflecting external fear and distraction, not the internal reality of the company.
There is an interesting counter-trend, though. Retail message volume around the stock is actually up 12%.
Really?
Yeah, people are talking about it more, even as the price drops.
Which suggests a significant portion of retail investors are recognizing this exact technical divergence. They're looking at the $3 price tag, they're seeing the institutional debt swap, and they're viewing this as a major bottom fishing opportunity.
So if retail investors are bottom fishing because they know catalysts are coming, what exactly are they waiting for on the calendar to prove the institution's right? Because we've established this massive gap between the bearish market sentiment and the improving fundamentals. At some point, upcoming events are going to force the market's hand one way or another.
The entire thesis hinges on the third quarter of 2026. That is the target for the initiation of the Delta-class glide testing operations.
Let's expand on how glide testing actually works, because it's not just firing a rocket straight up into the sky.
No, it's quite different.
The mothership carries the Delta class up to an altitude of around 50,000 feet and, well, simply drops it. The ship doesn't ignite its rockets, it just glides back down to the runway. So why is an unpowered drop the ultimate proof of concept?
Because the power descent is actually the most straightforward part of the physics equation.
Really? The rocket part is the easy part.
Relatively speaking, yeah.
Yeah.
They already know the rocket motors work. Glide testing proves the complex aerodynamics of the new Delta chassis. It tests the flight control systems, the telemetry under real atmospheric stress, the landing gear deployment, and the unpowered descent profile.
So it's all about how it handles in the air.
Exactly. If the ship can perfectly navigate a glide from 50,000 feet and land on a runway like an airplane, it proves the structural integrity and the new design optimizations are sound.
And if that Q3 glide testing succeeds, the schedule targets Q4 2026 for the actual commercial launch. There are also rumors floating around about potential accelerated testing timelines, or even the possibility of securing high-profile research payload contracts for that fourth quarter.
Oh, that'd be huge.
Yeah, if any of those rumors materialize, it could severely shock the market, given how low expectations are right now.
A positive surprise in this heavily shorted bearish environment would be explosive. But To know if that aggressive schedule is genuinely on track, the immediate hurdle is the Q2 earnings report.
The Q2 report is basically going to serve as the ultimate lie detector test for management. It will confirm if the Q3 testing schedule is holding firm, and crucially, it will show the exact state of the cash burn. We will see exactly how much breathing room that June debt swap actually bought them.
And we cannot ignore the downside risk here. Any technical delay, even a minor engineering hiccup in that Q3 testing phase would be absolutely catastrophic for the stock.
Because of the runway.
Right. When your cash runway is measured in months, not years, you simply do not have the luxury of pushing a testing deadline back by 2 quarters. There is zero margin for error.
Bringing this all together, how should someone listening weigh the bullish score of 6 out of 10 we're looking at against that massive zero-margin execution risk? It feels like standing on a tightrope over a volcano.
It is a high-wire act, for sure. But the reason the investment rating leans cautiously bullish, giving it that 6 out of 10, goes back to the engineering reality. The technology risk is actually lower than the market perceives because they are refining a proven system for scale. They aren't inventing a completely new method of space travel from scratch.
Right, they've done it before.
Exactly. The real risk is purely the calendar. Can they cross the finish line before the bank account hits zero?
So summarizing the landscape we've covered today, Virgin Galactic is a deeply oversold, pure-play space tourism stock. They've drastically de-risked their balance sheet and eliminated near-term default risk through a painful but necessary debt exchange that caused short-term shareholder dilution.
But institutions bought into it.
Exactly. The macro environment, heavily distracted by the SpaceX IPO, has pushed their stock down to $3. But everything now comes down to execution. They have to nail the Q3 glide testing and launch commercial flights in Q4 to finally unlock that $186 million in pent-up demand.
It really is the defining situation for the sector over the next 3 to 6 months. We'll have to see how the upside and downside play out.
Definitely. Before we wrap up, I want to leave you with a final thought to ponder that builds on physical infrastructure, specifically Spaceport America. We spend so much time analyzing the spacecraft, the cash burn, and the engineering timelines. But let's zoom out a decade from now.
The long-term view of the space tourism industry.
Exactly. Let's say ship designs change drastically in 10 years. Let's say new competitors enter the market with completely different propulsion technology. Even if all that happens, think about the specialized physical infrastructure.
Spaceports.
Yeah. The exclusive, highly regulated spaceports, the massive acreage required in unpopulated areas, the incredibly complex FAA regulatory approvals needed to fly these specific profiles over sovereign airspace. Could that physical real estate and bureaucratic clearance ultimately become the most valuable, irreplaceable asset in this entire sector?
It brings to mind the old railroad barons. It wasn't the specific steam train that made you a monopoly. It was owning the tracks and the land they ran on.
If you own the only approved operational spaceport with the necessary airspace clearances, it might not matter whose ship is flying in the future. They will all have to pay you the toll. And that hidden value is definitely something to keep in mind the next time you look at that $3 price tag. And with that, don't forget to subscribe, like, and comment underneath.
Remember to check out the VIP Algos link below in the description to help navigate these kinds of setups.
Thanks for listening, and we'll see you next time.